hope you guys understood this sum. Okay, we'll be doing the similar sum, okay, except for it's going to be marginal. Okay, we'll be like doing it for marginal. So that is what I have in the next tab, standard costing marginal. So standard costing marginal, it is not something which is new or great. It is just the similar sum, okay, the same sum with some few alterations. So we don't need to do the entire sum, just the changes I will tell you, and changes I will mark in a different color so that it is quite easily visible to you. Okay, so first we'll start from here, marginal. Okay, so in marginal that is going to be a little bit different only. We don't start from the, we don't start and end with profit, rather we start and end with budgeted contribution. So we have budgeted profit, we add the budget we have budget fixed cost, you have to add that. Okay, so once you add that, you will get budget contribution. You get budget contribution, and thereafter you get this so thereafter you can add this number and all. Okay, let them be there itself. Okay, so these variants will not change. There will be one change alone. This variance, okay, this sales volume, okay, variance will be changing. So there is a different formula for this alone. So we'll mark it in a different color. This will be a new thing that will change, and all other variances will be the same. Material, labor, variable overhead, all things will be changed except for fixed overhead expenditure variance. Okay, this alone will be there, but you will not have other variances. Okay, so other variances we can remove them, so these two will not be there. We'll minimize the space. Okay, so these two will be not there. The amount will be the same, amount will not change, only the other two variances will be deleted. Okay, that other two variances are deleted here. So at the end of it, okay, at the end of it, you will not get the actual profit, but you will get actual contribution. Actual contribution you will get, and finally you have to, so once you have got the actual contribution, you have to minus the actual fixed cost. Okay, so do this. So if you do this, you will end up with actual profit. So our actual profit in this case is 8,805. So that is a number. I think finally we'll check it. So we just have to recalculate this single number alone. Okay, we don't need to do anything else. So all our variances are same. None of them will change except for in this place. Okay, so and in this also, in sales variance also, only the sales volume will change. So that alone will mark it in a different color so that you can identify it. So what is the difference here? So the difference is the standard margin will not be profit. Okay, so it is not going to be standard. So first I think we'll change it here. It is for marginal we are computing, right? If we compute for marginal, then the standard will not be profit, it will be contribution. So contribution is will not be 3.5, it is selling price minus variable cost, which is equal to selling price here is, if you see, it is 25 minus the 12.5 material plus labor is 4 plus 2 is variable overhead. Okay, all of this put together will give you the answer. So in this case our SM will be these numbers. It is 6.5. Okay, so this also we will put it in another red color. Okay, so standard margin is 6.5. None of the other numbers change, just this 3.5 becomes 6.5. That's it, and we have to change as per like that. So our answer is still, see, it is in plus. They should have sold 2000 units, they have sold only 1600 units. Because of that, it is a bad thing, it is an adverse thing. So it is adverse by 2600. Okay, 2600 is adverse, so that alone we have to show it here. Okay, so volume variance is 2600. Okay, we have to also get these numbers. Okay, these numbers also we have to get. So let's get that numbers and all. So this number is something new, so we'll mark it as new. Okay, we need two numbers here. One is budgeted fixed cost we want, and actual fixed cost we want. We don't need to search too much because we have already done. Okay, we'll get it from the question itself, not a problem. So you can see the actual fixed cost is, so actual fixed cost is 6325, and the budget fixed cost will be, per unit it is 3 rupees, and they wanted to produce 2000 units, so it will be 3 into 2. Okay, 3 into 2000, which will be 6000, right? So we'll copy this. So we are getting just fitted from the question only, we are not like creating anything new at all. So we'll start. So budgeted fixed cost is 6000, and we'll also get this calculation. And actual is 6325. Actual fixed cost is 6325, which we should minus, right? So it's done. So I think we got all our numbers. We just have to work out certain numbers and get the answer. So first one is we have to add the fixed cost to profit, so that we'll get the budget. So we'll add it, this number and this number, add it, we got 13,000. Adjust all this. As this is an adverse number, put a minus symbol. Okay, put a minus symbol. So you should not be adding this, you should be adding budgeted contribution. So budgeted contribution plus the adverse variance, if you put, you got this number. So we got now this number also. Okay, it is favorable, that is not changing. So let's get the total cost variance properly. So all are like added properly. So our number is minus 2395. Okay, that is a adverse, so we'll put it as 2395. Actual contribution we have to find. Okay, so that would be sum of the cost variance, the sales price variance, and the standard profit on actual sale. Okay, we can't say this is as a standard profit, it is standard contribution on sale. Okay, so this also is a new wording. Wording alone is new, not much is differing. Wording alone is new. So we got, I think we got actual contribution, up to that we got it. Okay, from there on we have fixed cost. That fixed cost has to be deducted. So this number and this number, so if you add, I think it will deduct properly. So look at here, we got actual contribution. From that we have to deduct actual fixed cost. So actual fixed cost is 6325. I think that was the number we had, 6325. So that should lead us to uh, 7880 it is showing. Okay, I think why it is not showing the correct number, we don't know. We'll just check it. 925 seems to be the problem here. Okay, there's a 925 which is the problem. Let's check and we'll see. Fixed overhead expenditure variance alone is the number we want. Sorry, okay, it's not fixed overhead. Expenditure variance is 325. Is it adverse? It is adverse. Okay, so we'll find out like what is the difference between these two numbers. Okay, so the reason why we are not getting the answer, okay, is because of the expenditure variance. So you don't need to show this variance, okay, separately in marginal costing. You can just indicate that there's a variance. Okay, so you can just take 2070. Okay, don't show direct this, just you have to show this, don't add it or do anything. So the balance 2070 alone will come here. 2070, so that would come here. So your actual contribution is 14530. Your actual fixed cost, okay, we'll put it here. Your actual fixed cost is 63205. I think we found it from top. Your actual profit is 8205. Okay, how can that be? Because the question told us 8805 is the actual profit. So what is happening here? See, what is happening is here is we have to work out in a different manner, because this sum in a different manner, because in marginal costing, okay, your actual profit will come to this number 8205. Okay, because actual profit before adjusting fixed cost closing value. Okay, see, the company has produced around 2000 units. Okay, they thought they will produce 2000 units, but they have produced only 1800 units. Okay, so there is a volume difference there. Okay, there is a volume difference there. So that volume difference has to be adjusted. Oh, okay, so better you can, rather than doing all this particular step, what you can do is you can put it as fixed cost closing value. So 2000 units we thought of producing, we produced only 1800. So there is a difference of 200 units. Okay, this 200 units per fixed cost value is, see how much it is. It is fixed cost value is 3 rupees per unit. Okay, so there is a difference between what you thought you will produce and what you have actually produced. So that number has to be adjusted. Okay, or else we won't get the answer. So adjust it, and your actual profit, okay, would move to this number. Okay, that will move to this number 8205. So that 8205 is now you are getting tallied. Okay, so this is how the sum works out. So hope you got the difference between the uh, marginal and operational. Okay, so if you want, I will put both side by side so that you could get a better picture. You will get a better picture. Okay, so you could see here and how it works. So marginal costing statement will be a little bit lengthier. Okay, because there are like some more adjustments when compared to absorption costing. Okay, so that's about the concept here. We'll move on to our next sum.